Hello everyone, it's me again, Peter Harris with Commercial Property Advisors, author of this book, Commercial Real Estate Investing for Dummies, and coach and mentor to many investors across America. The title and subject of today's video is Funding Commercial Real Estate Deals. So let's get started. I'm going to keep everything very simple and straight to the point for you. So this video is an overview of the different ways for you to fund your commercial deals. So I'm going to start off by comparing residential lending to commercial lending, and then I'm going to discuss conventional commercial financing. There are about 8 ways to get your deals done. I'm going to discuss the requirements, down payments, and how the different types are used. Then I'm going to share the likes and dislikes of commercial lenders and how to put your deal in its best light. And then lastly, I'm going to discuss the creative commercial financing, which is my favorite. And they include owner-carry first mortgages, owner-carry seconds, master lease agreements, and the newcomer, crowdfunding. All right, so let's get started. Let me start off by saying that obtaining a loan for a commercial property is somewhat similar to getting a loan on a single-family home. For example, in both cases, you have to apply for a loan, you have to show that you're creditworthy, and you must have a down payment. But that's about where the similarity ends. Lenders separate all real estate loans into 2 piles. The first pile is the residential pile, and the second pile is the commercial pile. Residential properties fall under single-family homes, duplexes, triplexes, fourplexes. Commercial properties fall under properties outside of that. They include apartment buildings with 5 units or greater, retail centers, strip centers, office buildings, industrial, self-storage, mobile home parks, hotels, motels, and even raw land. A mixed-use building containing apartment units and commercial spaces also fall under commercial. Now, let me share with you the 3 main differences between residential lending and commercial lending. Number 1, in residential lending, the lenders look at the borrower first. Commercial lenders qualify the property first before they look at the borrower. So they look at the property's ability to produce enough income to support the expenses and the mortgage. And the borrower's qualifications are second priority, basically. Again, this is the exact opposite of residential lending, where lenders qualify the borrower first and the property second. Got it? Okay, number 2, the down payment requirements in commercial is typically a little more. Sometimes it can be 25 to 35% of the sales price as a down payment, where residential you can get a down payment as low as 5% to maybe up to 20 to 25%. And the reason why commercial requirements are tougher is that they want you committed to the loan, because the loan amount is higher and also the risk is higher. And basically the saying is the lender wants you to have skin in the game. All right, number 3, lastly, commercial loans usually mature in about 10 years or less, while residential loans can go as long as 30 years. Here's the reason. Commercial lenders, when they make a loan, they commit to the property, they commit to the borrower, and they commit to that neighborhood. And to them, that's risky to be committed for that such a long time. They do not want to get caught in a downturn. So they make a loan for a shorter period of time, giving them an opportunity to get out or renew the loan every few years. All right, got it? All right. Okay, let's move on. Next, let's discuss what commercial lenders like and don't like. All right, so commercial lenders like properties that have solid cash flow. In this business, in the commercial business, cash is king, and if the property is cash flowing well, you'll be in a position to take care of the property and of the property's needs, basically. The greater the cash flow, the lesser the risk the bank sees you and the property. Next, lenders like to have evidence of a strong operating history. If the previous owner is operating it well, before you bought the property, that's proof to the lender that you can do it too. Lastly, lenders like properties that are in stable and growing neighborhoods. If you bring them a property where jobs are declining, you'll likely be turned down. Okay, here's what lenders don't like. They don't like properties that have poor financial records. What I mean by this is this could be a major dig killer, plus it can also lower the property value. They don't like properties that are poorly maintained. Nothing kills a superbly cash flowing deal quicker than a dirty, unkept property. They also don't like properties that are in suffering markets. If your deal is located in a area that has high vacancy, plight, and poverty, the lender sees this as too risky. All right? Okay, so let's move on. Here are the 8 most common commercial or conventional commercial loans. All right, number 1 is long-term commercial loans. So these loans can go up to 10 years in length and at a fixed rate. If you don't plan to sell the property for a while and you like to keep your property's cash flow going, you should consider a long-term loan. Also, long-term loans tend to have higher interest rates than shorter-term loans. Okay, number 2, short-term loans. These loans are usually up to 3 years in length and typically have a lower interest rate than long-term loans. If your investing strategy calls for you to sell the property in 3 years or less, this may be the loan for you. All right, number 3, conduit loans. These loans are good for properties that are stable, well established with solid tenants. Interest rates are usually low with fixed amortization rates. These loans are considered, or most of these are considered non-recourse. And let me tell you what that means. Non-recourse means that the borrower isn't personally guaranteeing the loan. And not being liable for the loan, just in case something goes wrong, is a good thing for the borrower. All right, and lastly, non-recourse loans must be a certain amount, and they must be between $2.5 to $3.5 million to get one done. Okay, number 4, U.S. government agency loans. Did you know that 20% of all commercial loans given in the U.S. are somehow tied to the government? It could be FHA, Fannie Mae, HUD, are just a few types of government loans available. Now, these government agencies are not the lenders, they just insure the loan. So you would go to B of A to get one of these loans, but the government would insure it. Okay, number 5, construction loans. These loans are taken out to fund the ground-up construction of a property to completion or until it reaches a certain leasing percentage. And construction loans are the toughest of all to get approved. All right, number 6, bridge loans. These are short-term financing loans and is used to bridge the gap between finding a permanent loan and actually closing on a permanent loan. So they're just a bridge. All right, so these loans are usually useful for funding deals quickly, but they can be costly because they're really effective in allowing you to capitalize on a deal that you normally couldn't or been able to. All right, number 7, small business loans, small business administration loans, or the SBA loans. If you plan on occupying at least 51% of the property, check out an SBA loan. And with these loans, a down payment as low as 10% is possible. Another benefit of the SBA loans is that the interest rates are typically much lower than a conventional loan. But remember, SBA loans aren't made by the Small Business Administration. They merely insure the loan. So you have to go to an SBA approved lender to actually receive this type of loan. All right, lastly, hard money loans. If you have bad credit, recent bankruptcy, or the property needs to close in a few weeks, you can use a hard money loan. These lenders typically require a hefty down payment, probably up to 35% or more, and interest rates are exceptionally high, 12% to 18%, and also on top of it, there's an extra 3 to 10 points or 3 to 10% points multiplied by the money just to use the money. All right, next let's get into my favorite topic, which is creative commercial financing. Here's the situation. If you're the buyer and you fit under one of these categories, this may be a fit for you. If you have little cash, if you can't get a loan because you have poor credit, you have no credit, or you desire to leverage whatever money you have, or you need short-term financing. Or let's say you come across a seller who wants to avoid capital gains or delay capital gains after sale, or you come across a situation where you would have to pay a large prepaid penalty on a loan if the seller sells a property, or let's say the seller is ill or has personal situations or circumstances that hinder him from operating the property, and because of that the property is in poor condition and poor physical condition, but he needs to sell the property for whatever reason. All right, this is well, let's say, what if the buyer is tired or burnt out, or the property is underperforming because of that? Then, of all those cases, these are all potential cases for creative financing to take place. But let me tell you a secret. Here's the secret to doing the best creative commercial financing type of deals. Here's the answer. Ask. You have to ask. All right, that's the key. All right, next I want to get into the 4 different types of creative commercial financing methods. Number 1 is owner-carry first mortgages. Number 2 is the owner-carry seconds mortgages. And number 3 is the master lease agreement, which is one of my favorites. And number 4 is a newcomer, crowdfunding. We'll discuss that too. All right, so in any market, strong or weak, investors like yourself should be armed with tools and know-how, because every deal you'll do will be different in nature, along with just different challenges. So it's quite possible that your next deal may use all 4 of these methods at once, a combination thereof, or just one. In any case, I want to encourage you to be armed with these type of funding tools. All right, so first let's discuss owner-carry mortgages. All right, so if a seller has, for example, no debt on the property, he can act as the bank for your financing needs for the purchase. Simply put, he holds the mortgage for you. For example, if you purchase if the purchase price is $500,000 and you put down $50,000, then you would make monthly payments on the remaining $450,000 balance, which is the owner carry. Now you have to have agreed upon loan terms for you to sell or to finalize, but that's what a owner carry first is. So the owner is carrying a mortgage on your behalf. All right, he's the bank basically. But here's the question. Why would he do this for you when he could simply... Here are 2 possible answers. Number 1, the seller may not want to pay taxes on the sale. So in this situation, the seller can delay capital gains taxes at the sale and spread out his tax consequences over a period of time. All right. Second answer or reason could be the property is well below market vacancy and in poor physical condition. You're going to find quite a few of these properties, and this means that the bank, a normal bank, will not lend on a property until it can show a profit and have its physical problems fixed. This is what's called typically a non-performing or distressed properties, and commercial lenders do not like to lend on these type of properties. Okay, next, owner carry second mortgages. Owner carry second mortgages have been quite popular since the origination of mortgages. Let's say the buyer does not have quite enough saved for a down payment. He only has 15%, but he needs 20%. So the seller can help the buyer by holding a second mortgage for the 5%, all right? Thereby satisfying the lender's equity requirement of 20%. Here's an example. The purchase price for a 10-unit building, let's say, is $500,000, and the down payment required is 20%, or $100,000. But the buyer only has $75,000, which is 15%, so he's 5% short of the money required. So what we can do, that the seller can agree to hold a second mortgage against the property for the remaining 25%. All right, so now everyone's happy. The seller gets to sell his property, the buyer gets to purchase the property, and lastly, the lender's requirement of the 20% down payment is satisfied. Okay, here's my favorite. It's called the master lease agreement method of financing commercial real estate. No banks are required. All right. Master lease agreements have been around for centuries, and I want you to think of a master lease agreement as a lease with an option to buy principal. That's the principal we use for a single-family home. The lease option term is usually slated for single-family homes, but for commercial properties, it is typically referred to as a master lease agreement. And in simple terms, here's how it works. You will buy the property. You will buy the seller's property by giving him a small or no down payment in some cases in exchange for all the rights and privileges of owning the property without legal title changing hands. At close, you get what they call equitable title, not legal title, until the agreement extends. You're entitled to the property's cash flow, tax benefits, day-to-day management, and because your price and terms are set, all the upside is yours to keep, all of it. All right. The more efficient you are, the more money you make, and as you increase the property's NOI, the property's increase in value and cash flow becomes yours. Now, all the seller gets is a monthly payment from you, which is usually just a mortgage amount. And once you sell the property, every dollar above the master lease agreement price that you agree to is your profit. Okay, last but not least, we have the newest way to fund our commercial deals, and that's with crowdfunding. Crowdfunding is a collection of money from backers or the crowd to fund a real estate deal, and it usually occurs on internet platforms, a website. This is a new kid on the block, and it's becoming quite popular. Crowdfunding websites has grown from raising roughly $90 or $89 million in 2010 to over $5 billion in 2013. So here's how it works. Once you submit a deal, once you find a deal and you think it's a good deal, you submit it to the crowdfunding website for approval. And once it's approved, the website will send your deal to as many investors to get them to invest in your deal. And this used to be illegal until 2012, until President Obama signed a law called the Jobs Act into place. Okay, and then about a month later, if your deal is a good one and investors like it, the money is in an account waiting for you to be used for your down payment. Now, here's some parameters. They usually want to pay their investors about a 7 to 10% annual return plus a split of the cash flow. All right. They won't fund 100% of your down payment, but they'll do most of it. They want you to have some skin in the game yourself. But here's the kicker. You need to be experienced for a crowdfunder to fund your deal. They reject over 95% of the deals submitted, over 95%. So make sure you know what you're doing. All right, so there you have it. And this was a quick overview of commercial funding, commercial lending. Hopefully by now you have a better understanding of how to fund a commercial deal. So let's get out there, let's get busy, and let's get a few deals done. Okay? All right, hope you enjoyed this video. You can get access to even more great resources at commercialpropertyadvisors.com, as well as subscribing to this YouTube channel and watching more of my videos. Thank you for watching this video on funding commercial real estate deals. Thanks, everyone.